Ladies and gentlemen, welcome back to another episode of Money in Medicine. If this is the first time you have joined our channel, very warm welcome. Stefan, for the first time listeners, just a quick summary of what Money in Medicine is about and what I can expect from this channel.
So predominantly our target market is we focus on medical professionals, and what we found is that there is a big gap in terms of understanding financial decisions that they make and understanding financial jargon, financial terminology. Obviously, they study 6+ years in order to get the degree, but nowhere in that degree or qualification is there any financial terminology. So the purpose of this platform was to educate and empower medical professionals so that they can make informed decisions in their finances.
Today in the episode, we're going to discuss the most tax-efficient investment vehicles that's available to you. There are a couple of investment vehicles that we're going to touch on, and it's important to identify the correct investment vehicle for your specific goal. Stefan, to start off with the first investment vehicle, I think that's also the most common investment vehicle that a lot of people know about when they start investing, and that's a retirement annuity. Yeah. What's the tax benefits of investing into a retirement annuity?
Thanks, Van. And I think it's also just important to mention that most tax-efficient vehicles on a linked investment service provider is what we're going to discuss today. And a retirement annuity is the one investment solution or one investment vehicle that offers you the opportunity to deduct or to minimize your taxable income. And what I mean by that is if for every R1 that you physically invest in a retirement annuity, you get the tax portion back from SARS. So if you on an effective tax rate of, let's say, 30%, for every R1 you invest, effectively you'll be getting 30 cents back from SARS, which is a powerful benefit. If you think about reinvesting that money back into your retirement annuity, every year you get your returns. So let's say, as an example, you invested a couple of $1,000 and you get a couple of $1,000 back from SARS, and you take that return and you reinvest that back into your investment, it already spills over to the next year.
If you use the 30% example, it's basically a guaranteed return of 30% on your investment.
100%.
Because SARS refunds you that 30%.
Yeah.
If you reinvest that 30% into your retirement annuity by way of a lump sum,
Definitely.
It's a guaranteed return of 30%. And
Definitely.
I think it's over and top of your actual return that you're getting on the investment.
Definitely. And on that note, the investment returns within the fund is also exempt from local taxes. So you will not pay dividend withholding tax. You will not pay capital gains tax if there's any switches in the fund. There will be no income like interest tax on the investment. So all of that is benefits, again, that just exemplifies and just, creates additional growth on this investment. There's nothing that's deteriorating in the form like taxes that's reducing your yield or reducing your growth on the investment. So retirement annuity is definitely, I would say, up there. One of the investment vehicles that you have to have in your tax-free strategy.
I think it's also very important to mention that that you have to sit down with a financial advisor to do an actual calculation, because there are certain limits in terms of how much you can invest. You can't just basically go and invest R1 million into a retirement annuity with the hopes that SARS is going to refund you 30% and then you get a return of 300,000 Rand. There are certain limits. So I would encourage you to sit down with a financial advisor, have a discussion, look at your portfolio and see how are you matching up to that limit before you're just going in there and investing that.
True. The second investment vehicle that I would definitely recommend is a tax-free saving. Let's start with the limitations. So let's first start with sort of like the downside to a tax-free saving, and then let's talk about the tax benefits. So the first thing is you can only invest 36,000 Rand per year, which obviously seems like a lot, but if this is like compounding over time and it becomes quite an important vehicle in your arsenal or in your investment strategy, then 36 holistically to your whole portfolio could actually be quite a small amount. So you are limited to 36,000 Rand.
Currently, so we have seen that when tax savings accounts was introduced in 2016, that limit was 50,000 Rand. Yeah. And then they've increased it to 33, and we're currently at 36.
Yeah.
So there are basically hopes that it might increase at a later stage. And in terms of that limitation, there's an annual limit or a lifetime limit, not an annual limit, a lifetime limit of 500,000 Rand. You can't contribute more than 500,000 1,000 Rand in your life towards this.
Something that I just want to also, that I get quite often is it's important to note that it's only the contributions, it's not the growth. So if you invest, let's say 30,000 Rand in your investment and it grows to 36,000 Rand, they won't see that additional 6,000 Rand as part of your limit. It's only what you contribute. So if you contribute, you can only contribute 36,000 Rand per year. If that grows to 300,000 Rand in that year, it's your benefit. Okay.
Stefan, I got asked a question the other day where if you transfer money from one tax-free savings account to another tax-free savings account, basically from one company or service provider to another financial service provider, does that form part of the limit or has that been waived?
Very, very important to talk to a financial advisor if you are planning on doing something like that, because if you withdraw the money and you reinvest that into another tax-free saving, it will be seen as part of your contribution. However, if that transfer is done in the correct fashion, it has to go through certain procedures, then no, it won't be seen as a contribution. Then you can just continue on another platform. Very important question.
Very important thing, yeah. Then let's discuss the tax benefit of a tax-free savings account.
Yeah, so no income tax. So there's physically no income tax, no capital gains, no dividend, no foreign dividend, nothing.
No tax on the withdrawal.
Nothing. So it's a brilliant benefit for long-term goals. Stuff like, let's say you've got a newborn child and you want to fund education in 20 years from now. Because remember, if you do that through a normal investment, something like capital gains can hurt you in 20 years from now. So it's very important to look at a tax-free saving because in 20 years from now, that proceeds will be paid tax-free. Again, something like retirement, a lot of people don't think you can use a tax-free saving as a retirement, and I totally disagree to that because a retirement income one day will become taxable as per current tax legislation. So a tax-free savings income that you draw from that account will not be taxed. So you can actually take a lower drawdown on your retirement annuities and then just supplement or complement that with your tax-free income.
And I think if it's like you said, it's a great vehicle to use to supplement retirement savings.
Yes.
From a tax perspective.
Yes.
But also very important to mention that you have to start it as soon as possible.
Yeah.
Because you want to basically make up that 500,000
Sure.
lifetime contribution.
True.
Because you are limited to 36,000 Rand a year. If you start too late, you're not going to use the full benefit of a tax-free savings.
100. And it's also important to note that you need to try and max out if you're in that position, to try and start one for everybody in your household. Children, you can start it for children, you can start it for a spouse. Try and max out for every person. So you're not limited to 36 per household, it's 36 per natural person.
Yeah. And you're only allowed one tax-free savings account.
Sure. You can have more. Yeah. You can have more.
The limitation stays the same.
But the limitation stays 36. So if you have one with company A and one with company B, the aggregate can't exceed 36.
So it's not that you're going to have 36,000 Rand to contribute with company A and another 36 with company B.
No. It's not allowed.
Then that brings us to the third vehicle, which is called an endowment. An endowment is also a great tax-efficient vehicle. I think it's more aimed at high net worth clients.
Sure.
How exactly does the tax benefit work on endowments?
So an endowment is quite unique. It's actually taxed within the five-fund approach, which is just a smart word for it's taxed within the fund. So it's a different legislation that it's taxed upon, and it's taxed at an effective rate, a lower effective rate. So it's important to understand that if you look at your total portfolio, again, this is why it's important to talk to a financial advisor. A lot of people just introduce an endowment from the word go, but their effective overall tax rate is still lower than what they will pay in an endowment. So it's actually costing them more in taxes. So hence to your point on it's actually more geared for higher net worth clients, absolutely correct, because a higher net worth client is on a marginal tax rate of, let's say, 45%. So an endowment is taxed effectively within the fund at a much lower rate. And this is very, very useful, specifically for capital gains, specifically for income tax one day. So all of that benefits is something that is more geared for somebody that's got a bit of a tax problem. My recommendation would be to try and first utilize, again, obviously depending on the term, but to try and first utilize your tax-free saving. If that is maxed out and you don't have like an option B, then to try and introduce an endowment. The downside to an endowment, it has to be fixed for 5 years. They do allow one withdrawal on the 5 years, but that's it. Otherwise you have to wait for the 5 years to pass.
So technically, what I've gathered from what we've discussed now is it seems like the bigger the tax benefit, there is certain limitations involved.
Yes.
So like with a retirement annuity, you get the rebate from SARS, but you can't access the money before the age of 55.
100%.
With a tax-free savings account, everything is completely tax-free, but you are limited to a contribution again. And now similar with an endowment, you are taxed at a much lower rate, but you are basically, you're limited, you can't access the funds within the first 5 years.
Very true. Then just another thing to mention on an endowment, and this is more from an estate planning perspective, which makes it an endowment quite nice, is you can physically nominate a beneficiary. And then that money will be paid directly to the beneficiary. It won't form part of your estate, which is then again a nice way to get around executive fees. So there won't be any executive fees applied to the endowment unless obviously you didn't nominate somebody and it goes into your estate, or you've nominated your estate for liquidity purposes. But if you've nominated a third party, a spouse or whoever, it will go directly to that person, which is a big benefit from an endowment.
And then I think also very important to mention on endowments is when you make a withdrawal, the funds that you take out of the vehicle is not going to be taxed.
No, it's already, the tax is done.
You don't pay any income tax or anything on that.
No.
So it's completely tax-free.
It's done within the fund already. So if you get a surrender of 100,000 Rand, it's done. It's done and dusted. That 100,000 Rand would be paid to you.
Okay. Then the another common vehicle that's very popular when you resign from a company, specifically when you enjoy benefits like a pension or a provident fund, is called a preservation fund,
yes.
Which is also a tax-efficient vehicle in a certain sense.
Yes.
Because when I think for those of you that have ever left a company, such as if you have been employed by government and you decide that you are going to private practice or you are going to work overseas for a couple of years, you would get a form from your HR which basically give you 3 options. I think one of those options are to take the contributions to your GPF in cash. The alternative option is to transfer it to a fund of your own, or you can then transfer it into what I call a preservation fund.
Yes.
What is the benefit of transferring it into a preservation fund from a tax perspective?
So I think the first thing is, like you mentioned, a lot of people don't know they have that option, and they want to take their pension savings and they pay withdrawal tax on that money, which is quite a lot. You can actually deteriorate your wealth, hard-earned money, which is actually being saved for retirement by taking that withdrawal. And what people also don't realize is one day they will again look at that withdrawal. So one day when you pay physically tax when you're going to start retiring, there's also an implication for having early withdrawals throughout your career. So your option is then to basically preserve the money, and that's where the terminology of a preservation fund comes in. It's to protect it in this fund. It's in my view a retirement annuity excluding contributions. So it's got the exact same rules. There's no income tax within the fund. Your money is parked there. It will still obviously grow because it's still got market exposure, but you can't contribute towards this fund. The benefit of this fund is you still have your one withdrawal of the fund. So again, why I will always, recommend exploring the option of a preservation fund is you never know what happen in the future. Obviously, the purpose of this money is for retirement, but again, you have that option to withdraw the money if you really need it, and it stays exempt from local taxes whilst it's accumulating in the fund.
Yeah, that's a great vehicle, and I think it's important to protect yourself from the tax perspective. Like you mentioned, a lot of people just go and say, "Listen, I'm going to take this money cash," but they don't think of the tax consequences that's going to basically be forced upon them when they go into retirement.
Yeah, and like you said, a lot of people take the money cash, but then they reinvest the money in non-retirement investments, discretionary investments, where that then becomes fully taxable. So not only do they pay withdrawal tax on the money, where they lose 20-30% of the fund value, then they reinvest that in another vehicle where it becomes totally taxable. So there's capital gains tax, dividend withholding tax that applies to this investment. Whereas if you could have just lost it in your or just left it in your preservation fund, it would have grown at exempt from local taxes. So the value of that is exponentially over 20-30 years from retirement. So that brings us to the end of this episode. Again, the purpose of this was to explain a couple of investment solutions. If you are looking to invest on a linked investment service provider, please go talk to your financial advisor if you need more advice on any of these vehicles, or feel free to reach out to us on www.moneyandmedicine.co.za. If you did find this useful, please go down to the bottom of this page and subscribe. Leave some comments. We will get back to you. And until next time, Land the plan.